3, 2, 1. Yes. And we are live. All right, come back into focus here. How you doing, friends? Ernie here. And this is the 0 Days to Expiration podcast. It is Friday, the last trading day of this week, and the day before a long weekend. We have no trading next Monday because it's a holiday. I think it's President's Day. Is that right? Yeah, President's Day. And because there's no 0 DTE on a holiday, on a Monday, that means that there will be a 0 DTE on Tuesday. So then we'll have 2 0 DTE days or expirations in a row, Tuesday, Wednesday, and then Friday of next week. That's the way it works when you have holidays. They put Monday to Tuesday and Friday holidays to Thursday. All right, now that we got that cleared up, again, this is episode number 79. That means that there are 78 other episodes just chock full of information about 0 DTE and trading in general, and particularly trading the last day of expiration with options. Oh, forgot. There is one missing episode. Episode number 70. No one knows where it went. Even I don't know. But soon it shall appear. I hope. All right, so today's episode is about a very important topic in how we actually model our 0 DTE trades, the options trades. Now, it's very important that we have a good idea of where we think price might be going by the end of the day. Now, there is a theory that the max pain point or the max pain strike is where price will tend to gravitate towards, because the big option sellers, the institutional sellers of options, well, that's where they're going to make their max profit as an aggregate of all of the different sellers of options. And it's also the place where people are going long in options. The aggregate number of people are going to find the maximum loss. So with that, all of these institutions tend to try to manipulate price to get right to that max pain point. Now, that is all great in theory, right? It works in theory, but in theory, it doesn't work. No, it works every once in a while. As a matter of fact, last Friday, we had a nice pin trade right on the max pain point, and that worked out very well for us. But it's not a guarantee. However, one thing that you'll note about that max pain point, if you go into your options chain and look at open interest and volume, you'll see there are levels where the open interest and the volume are extraordinarily high compared to the other strikes. And that max pain point is usually one of those extraordinarily high open interest levels. But there are others as well. And they could, in fact, also be max pain points. Now, today, I believe the max pain is at, I believe it's at 4,400. Is that right? 4,400 or 4,450 maybe? I'd have to look. But it is definitely above the current level where we're at right now. Now, you would think, well, does that mean, Ernie, that price is going to be gravitating towards that price? Well, it might, but it might not as well. There are other levels that also have extraordinarily high open interest, for instance, at 4,350 and also at 4,300. So those also could be places where price will gravitate towards. Now, here's a very interesting point. Those levels, those strikes with that extraordinarily high amount of open interest and volume, where there's a number of contracts open right there, also correspond very nicely to the volume profile and high value nodes on the volume profile. So one would think that, hey, there must be something going on here, right? Well, there is. And in fact, we do our initial analysis using volume profile at the beginning of the day and determine what the market structure is based on the volume profile. The profile provides, like I said, a structure or a structural map of prices and the range of prices that we feel that price will traverse around that day. Price tends to gravitate towards those high value nodes where there is an abundance or a larger distribution of prices concentrated on particular levels. So that is what we do. We look at those particular levels and we come up with scenarios on where we think price is going to go based on those levels. So once we've got the map all figured out and we draw lines across the nodes, we can figure from there, we can figure out where our targets are, where support and resistance is. All we then have to know is, well, what's our bias? What direction or what is the vector? If you know anything about vector math, I'll clue you in on a bit. It contains two basic characteristics. What is the vector of price? A vector is both direction and magnitude of that direction. In other words, how much energy is behind it. So every morning we try to get a feel for what is the vector of price, the direction and magnitude. Once we know that, we then transpose that on top of the volume profile. And then that will also tell us or give us clues on what the projected behavior of that price will be, because we have rules around, well, what happens when price traverses a profile. So once we know those two pieces of information, we can create a scenario map of where we think price is going to go. And in fact, I've demonstrated this many, many times online, as well as with Bitcoin. That was one of the areas where I got a lot of recognition back in 2017, where I was able to project the price of Bitcoin over the course of 6 months by using this technique. And we use this for, it is used for just about, well, it can be used for every type of asset. No asset is free from this type of analysis. Volume is volume, whether it's Bitcoin or the E-mini S&P or Apple or whatever. Everything pretty much works the same. If there's a lot of volume there, it tends to attract price. On the edge of nodes, it tends to provide support and resistance. On volume wells where there's a distinct lack of volume, price tends to scoot through there or trend through there or get rejected. So these are the behavioral elements. So that's okay. So there's a quickie on volume profile. Now the interesting thing is that when you go into your options chain and you've got your scenarios and everything plotted out on the profile, now it's time for you to come up with an options strategy that models these scenarios that you've created so that you can predict where you think price is going to end up by the end of the day, because our primary task here is to try to place a premium collection strategy over where we think price will end up. That will give us the maximum ability to profit, because on the last day of expiration, premium in those strategies is decaying at an exponential rate, and we can collect that premium. So if we can be right where we think it's going to end up by the end of the day, where premium is accelerating and decaying at its maximum rate, then we can profit very handsomely. Of course, there's a spectrum in between that and the risk, the defined risk that we put up. So we try to be somewhere within there. And we can be pretty loose. We can come up with a very wide, or model a very wide range of prices. But ultimately, we want to use the volume profile and this open interest, which correlates very strongly to the volume profile. And that essentially is pointing to where price or the market is going to try to push price towards, because that's where the sellers of options will gain the most. Makes sense, right? So that's a little secret that a lot of people don't really maybe pay attention to. They just put on their strategies and that's it. But if you look at volume profile in conjunction with the open interest, map those two, find out where they overlap, where those points are strongest. Then when you're creating your options model, you place it in such a way that gives you the greatest probability of profiting, all based on your analysis, your behavioral analysis of where you think price will end up. I know it's like all these things coming together, right? It's kind of like, being the hitter in a baseball game, and you're throwing a curveball, and you have to follow that curveball and anticipate where it's going to be, and then swing the bat and hit it right on the sweet spot of the bat. And that's essentially what we're trying to do. Now that makes it sound more difficult than it is, because unlike baseball, where you actually have to make contact, we don't need to make contact in order to profit. Now, if we make contact, that implies that we have pinned the tail on the donkey or hit the ball out of the park, because we met expiration right at the very last minute of the day on the very strike that it said that, that we figure will provide the most premium collection. Now, if we miss that point, there's a whole range of prices that we can still expire at or get out prior to expiration, where we can profit very handsomely. And if we put a strategy or a model, an option strategy, in such a way that it has asymmetric risk to reward, we can make these bets on extraordinarily large amount of profit relative to our risk, hence the name asymmetric. So putting all these things together, we can use these tools to figure out where to put an option strategy, devise an asymmetric trade, and then place it there and have really just sit and wait attitude. And we don't have to manage our risk, because the risk is very small. What we're really after is, well, how can we manage our profit? Now, if you have multiple contracts, you might have a strategy where when price gets close enough at some point in the day that you can take off a number of contracts that will provide enough profit to guarantee a profit, regardless of whether or not the remaining contracts go to max loss or profit or whatever. You could do that. So for instance, if you had 5 positions and then you could take 3 off, they could guarantee a profit. Regardless of what happens with the remaining 2, then that's what we're going to do. That's a strategy. Then we can wait and see if those remaining 2 will get close to the pin trade. If they do, they could in fact return many multiples of the other contracts that we took off in the first place that guarantee a no-risk trade. So there's an idea of a strategy we might use, but it all is really predicated on where that target is, how open interest and volume in the options chain correlates to the volume profile, what is the price vector so that we can figure out what is the anticipated behavior of price as it traverses across the profile, or what we call the market structure. And where will all that meet right at the end of the day so that we can hit it out of the park? So there you go. Now you know everything there is to know about trading the last day of expiration, the 0 DTE. Let's see. Muro's asking, so volume profile could also work on a higher time frame for longer strategies? Of course. Yeah, it's all fractal. So yes. In fact, we always start with the widest range profile with as much data as we can, and then work down so that we take in all of that older information as well, because it could be potentially impactful to what's happening that day. Let's see, Jeff is asking, some say that there's a certainty between buyers and sellers in the high volume node. I would rather say there is a maximum uncertainty because buyers and sellers are uncertain about the value. Well, you know, I don't care if they're buyers or sellers. That really it's really of little consequence to us. All I care about is the volume that occurred there. Because if there was volume there, they were both buyers and sellers. Now, whether they were a buyer or a seller really doesn't matter. All that really matters is where the point of control or the highest level of buying and selling occurred, and where's the sharpest drop-off of buying and selling, because that will provide you with your support and resistance zones. And also the lowest area of buying and selling, which we call the volume well, which some people call the low value node. I don't like calling it a low value node because it's not really a node. It's like the absence of a node. So we call it a well. You can call it a valley if you want. But the low point of the valley is also impactful, because when price traverses across the low part of a valley or a well, it often stops there, hesitates, and either scoots through very quickly to the next node or gets rejected back to the previous node. So that's an important behavioral aspect of volume profile. All right. So there we go. Now you know everything that you've ever wanted to know about
New visitor.
how we use open interest and volume profile together to pick our target points. And of course, there's a lot more that goes into that, actually coming up with the behavioral analysis, the structural analysis, and modeling the right kind of strategy to give us the right risk to reward. The asymmetry is so important too. I mean, that's really the crux of this. We don't want to be riddled with anxiety when we're in a trade, worried that if our trade goes wrong and goes outside of the profit tent of our option strategy, that we're going to experience a lot of risk. So we create strategies in such a way, and because of our analysis, we're able to put these strategies far enough out of the money to give us that kind of asymmetry. So typical asymmetry that we do, like today, was about 1 to 9, 1 to 10, 1 to 12, approximately. So for every $100, we have a potential of a maximum profit of up to $1,200, as an example. So those are the type of odds that we like. Now, of course, there's also a big spectrum in between there. Like I said before, you don't have to pin the trade. You just have to be close, and close enough really works, right? Doesn't work in horseshoes and hand grenades, but it certainly works in 0 DTE. All right. That's about all I've got to say. I want to thank everybody for the questions, and I hope everybody has a great holiday weekend. We'll see you next week on the 0 Days to Expiration podcast. Peace to everybody. Have a great weekend. Okay. Off button. Way up there. There it is.